Hello everyone. Today we'll be talking about EBIT EPS analysis. Before that, let's understand what is financial break-even, right? This is a line which says that if you go below this line, it will be loss. If you go above this line, it will be profit. This is the break-even line which has no profit, no loss. No profit, no loss means here your EPS is 0. As we understand break-even point, which makes you understand that there will be no profit or no loss in the business. After that point, you will start earning profits, but if you go below that, you will make losses. Similarly, please understand here, this is a point where your EPS will be 0, right? Now, today we will be understanding what is this EBIT EPS analysis. We have already talked about capital budgeting. That is investment decision where the investment has to be made, and accordingly we have decided how much money is needed. Now let's see what are the different sources of getting money. Now different sources are equity capital, preference capital, that is preference shares, equity shares, debentures, loans, right? There are many, but we are talking particularly about long-term debts, right? Now these will have an impact on your EPS. EPS is nothing but your earning per share. Now let's go to the basic thing, which says how EPS is calculated. Now please understand, any company starts with EBIT. EBIT is your earning before interest and tax. Now if I am taking any loan, I need to pay some interest. So interest is deducted from this. What do we get is earning before tax. Now once a company starts earning, right, you make profits, you have to pay taxes. Whatever the tax rate may be, so we deduct taxes over here. Now what is left is PAT. PAT is your profit after tax, right? Now profit after tax is the money which is available to the equity shareholders. We calculate EPS this way. PAT divided by number of shareholders. Now what is this number of shareholders? Say suppose our equity capital is 5 lakh rupees and per share the equity face value is say 10 rupees. So we divide it by 10. So how much do we get? 5,000 is our number of shares. So if I need to calculate EPS, I'll take PAT, that is profit after tax, divide by this number of shares. I'll get the earning per share. How much per share I've earned, right? That is calculated this way. But let's go to the basics. How do we calculate profit, right? How do we get EBIT? Let's start with this. First we do sales. Then there are variable costs which are associated with sales. When we deduct variable cost, what do we get? We get something which is called contribution. Now if we deduct fixed cost from this contribution, what do we get? We get EBIT. This fixed cost is the cost which goes on, right? Even when there is zero production. These are the costs which we incur. Here we get is EBIT. And from EBIT, as I have already showed you, we deduct interest, we get EBT, we deduct tax, we get PAT, and so on. Now EBIT EPS analysis says that the capital structure of the company has an impact on this EPS. If a company is totally 100% equity financed, the EPS will differ. If it is debt equity, then also the EPS will differ. Now let's take a sum to understand the concept.